Palantir stock is 35% cheaper than it was a few months ago. Most investors are seeing a bargain. I'm not so sure, because let me show you why the price can drop and still be expensive for investors, and what I'd actually do right now. By the end of this video, you're going to understand why Palantir dropped, what their May 5th earnings reports could do to the stock, why Burry is shorting it, and why Cathie Wood is buying it, and whether or not I think you should buy the dip. Palantir, ticker PLTR, hit an all-time high of $207 last year. Today, it sits around $146, and that's a 35% drop from the peak. Meanwhile, the rest of the AI sector has been rallying. So what's going on here? Two things. First, Michael Burry, the guy who predicted the 2008 crash and who I've covered in other videos, publicly said that Anthropic was eating Palantir's lunch. He deleted that tweet, but the damage was done, and the stock dropped 7% in a single day. Second, and more important, the market started questioning whether Palantir is actually worth what investors have been paying for it. And this is a story that I want to unpack today, because the price dropping doesn't automatically make something cheap. Now, here's what's interesting. The business itself is actually firing on all cylinders. Last quarter, Palantir's revenue grew 70% year on year, with US commercial sales up 137% and US government sales up 66%, with a net margin of 43%. So that means that every dollar coming in, 43 cents of it is pure profit. And most software companies and most businesses would kill for those kind of profits. Take a look at credit card companies, for example. They typically operate on 1% or less profits. Anyway, what does Palantir actually do? They build AI software that helps huge organizations make sense of their data. Governments, militaries, major banks, hospitals, data centers. And in fact, during the Iran war this year, their software was used for wartime planning decisions that would have been nearly impossible without artificial intelligence. That's not marketing, that's real battlefield use. And here's the thing almost everyone misunderstands about Palantir. Most AI tools help one person do one task. Palantir connects entire companies. It's kind of like the plumbing that makes AI useful at scale. One analyst called it the best story in all of software, and he's not wrong. So the business is genuinely excellent, but that's not the whole picture. Why it can drop and still be expensive. This is the part most investors miss. Now let me explain it in plain English. The PE ratio, price to earnings ratio, tells you how much you're paying for each dollar of a company's profit. Palantir trades at 214 times earnings. That means if you bought the whole company today, it would take 214 years of current earnings to pay back your investment. Even for fast-growing companies, a reasonable P to E is usually 30 to 40. Palantir is trading at 5 times that level. 5 times. Here's what that actually means. The market is already pricing in massive future growth. For Palantir to justify today's price, they need to roughly double their earnings in 2026, then double them again in 2027, then nearly double them again in 2028. 3 straight years of doubling. And if they hit all of that, you still only benefit from what they do in 2029 and beyond. See, that's the uncomfortable truth about Palantir. You're not actually buying into what they're doing today. You're paying for 3 years of perfect execution before you benefit from the actual business results. And the stock dropping 35% just brings it from extremely expensive to expensive. That's not the same as cheap. The billionaire divide. 2 of the most famous traders on earth are on opposite divides of this trade. Michael Burry, the big short guy, is shorting Palantir. He thinks the valuation is unsustainable and the competition from generative AI is going to take over. And he's been short on Palantir since September last year. Cathie Wood, who runs ARK Invest, famous for early bets on Tesla, Coinbase, and other disruptors. Well, she just bought 85,000 more shares of Palantir this week. And she's betting the long-term AI opportunity is bigger than the valuation concern. They can't both be right. One of them will look like a genius in 3 years with the money to show, and the other will look wrong. This is how it works in investing. Who do I think is right? Honestly, both, but at different time horizons. Burry is likely right in the short term because the valuation is extreme and any earnings disappointment could send the stock significantly lower. Meanwhile, Wood is likely right in the long term because Palantir is genuinely one of the most important AI infrastructure companies in the world. The 5-filter test. Now let me apply 5 filters that I like to utilize when looking at investments. I've covered this in a previous video where I explored the strategies of a $10 million investor. And he uses 5 simple questions to evaluate any company that he considers investing in. Number 1, leadership. Alex Karp of Palantir is a genuinely unusual CEO. Philosophy PhD, outspoken, willing to get in confrontations with Silicon Valley by working with the US military, but he's delivered significant growth and made Palantir profitable. That's a strong pass. Number 2, competitive advantage. This is where Burry's argument lives. Palantir has a real moat around it. Security clearances, 20 years of government contracts and relationships, the ability to handle the most classified data on Earth. But newer AI tools are competing on commercial deals, which is big money. The moat is real, but it's being tested, so this is a cautious pass. Number 3, vision. They were doing AI analysis before it was cool. Before it was a big trend. They keep expanding into new industries. They're clear innovators. That's a pass. Number 4, shareholder friendly. No dividends, no significant buybacks. Heavy stock-based compensation to employees. This is the weakest pillar for Palantir, so it's a fail on this. Number 5, resilience. They survived the dot-com era, 20 years of doubt and massive volatility. They're very resilient, and that's a pass. 4 out of 5 filters passed. Not perfect, but not weak. So this business earns a place on the love list, wish list of stocks to invest in. The question is now, at what price? May 5th is the big event to watch out for when it comes to investing into Palantir. And here's exactly what I'm watching out for. First, US commercial revenue growth. Last quarter, it grew 137%. If that pace is maintained or accelerates, the bulls win this round. If it drops meaningfully, say below 100%, the bears have a real argument. Second, operating margin. Palantir became profitable recently. The question is whether if that profitability is growing or shrinking. Expanding margins justify a higher valuation, whereas compressing margins are a red flag. Third, forward guidance. What does management say about Q2 and the rest of 2026? Analysts expect 74% growth in Q1 and 67% in Q2. If management signals they can beat those, the stock likely rallies. If they hedge or give cautious guidance, expect more downside. Options traders are pricing in a significant move either direction. Therefore, earnings data will matter a lot. Now, here's a historical parallel worth thinking about. Cisco in 1999. Cisco was the Palantir of its era, the company that built the plumbing of the internet. Everyone knew the internet was the future, and everyone wanted a piece of Cisco. The stock traded at over 200 times its earnings peak. The business was fine, and Cisco kept growing. They stayed the dominant networking company. But the stock dropped 80% from 2000 to 2002 and took 25 years to fully recover to its all-time high. Why? Because at 200 times earnings, you weren't betting on Cisco, the business. You were betting on the story being more valuable than the math. This is what Warren Buffett says when the price is what you pay and value is what you get. Palantir might be a great company, but paying 214 times earnings for any company means the price and the value have essentially separated. Eventually, they have to recover. Instead of asking how much can I make on Palantir, ask how much can I lose. At $146, if earnings disappoint and the price-earnings ratio compresses to 50, that's still a 60% drop. And that's the downside math that most investors are not doing. Should you buy the dip? So here's my honest take. I wouldn't buy Palantir today. Not because the company is bad. It isn't. Because the price currently doesn't leave enough margin of safety still, even with that drop. The starting point before this drop was an extreme over-evaluation. It was ridiculously expensive, and as I said, now it's expensive still. What I would do is put it on my watch list and wait for one of either two things. One, either a significant drop below $100, let's say, which is roughly 30 times forward earnings, which then starts to look like a company of this quality. Or two, a genuinely exceptional Q1 report on May 5th that forces analysts to raise the future growth estimates meaningfully. Either one of those things changes the calculation. And if you already hold Palantir, don't panic sell. The business is sound and the long-term thesis is intact, but don't chase it at current prices either. The Reddit investor I talked about in the last video with a $10 million net worth from basically nothing said it perfectly. My most profitable decisions were usually the things I decided to stay away from. And sometimes the smartest investment is no investment. Palantir is genuinely one of the best AI companies on earth, but that doesn't mean you should buy it at any price. Keep an eye on those May 5th earnings and wait for a better entry. Patience is the game to play.